Hey, Jason Manabuti here, and this week we're going to be making a special video for my house flippers out there. I've been getting a lot of clients recently who've been coming to me who are in house flipping, and it's either they were doing the accounting themselves or they were working with an accountant or a bookkeeper who doesn't really understand how the house flipping business works. So then therefore their books are a mess. Okay. So first thing is one of the biggest differences when it comes to house flipping is that the IRS is not considered as an investment, right? So you don't get depreciation. So then therefore your tax return should not have a depreciation for the properties that you are flipping, okay? And second of all, it's considered active income. So that brings us to our biggest error that we see, or should I say the most common error that we see with house flipper clients who come to us is that you cannot recognize expenses until the property is sold. So let's just say, okay, my team is going to put an illustration here, okay? So let's just say that you bought a property for $500,000 back in 2025, okay? Now it's 2026, okay? So you buy a property, $500,000 in 2026, you fix it up, and then let's say you spent, let's say, 200,000 on all the material, you spent 100,000 on labor, and then you spent another $50,000 on interest expense for you to borrow the money to fund this project. Okay. So you cannot expense the purchase of the property, the labor, the material, or the interest associated with the property until the property is sold. Let's say it sells in the end of 2026. So what happens is that $500,000, the $200,000 of a material, and $100,000 of labor, and $50,000 of interest. It's all going to go in your balance sheet. It's going to go on the inventory section. So here's your balance sheet. Okay. Here's your assets. So on the top of your assets, it's going to have your cash balances from all your bank accounts. Okay. My team is going to illustrate this here. And then right under that, it's going to have inventory. And that's where you're going to see purchase price of the property. You're going to see the material, the rehab costs, the labor, the interest. That's all going to go under inventory. And it's all going to be broken down. Okay. And then come June or July of 2026, once the property is sold, you're going to credit all that. So you're going to take it off the books. You're going to take it off the balance sheet. You're going to take it off the asset section of the balance sheet. And then you're going to debit or you're going to put it in the cost of goods sold section. So let's say you sell it for like, let's say $2 million, okay? So you're doing profit and loss is going to say income $2 million. And then your cost of goods sold is going to be broken down $500,000 purchase price, $200,000 of a material, $100,000 of labor, $50,000 of expenses. That's going to be your cost of goods sold. And then below that, it's going to be your gross margin. Okay. So another mistake that I saw was that I have a client who operates a business and they do flipping and then also they do wholesaling as well in the same business. They bought a property in 2022 and then they flipped it in 2024. But the interesting is that they forgot to include the purchase of the property on the balance sheet in 2022. But then at the same time, they were expensing all the rehab costs on the profit and loss statement. So that's incorrect, right? Because now you are overstating your expenses and you are understating the income, your taxable income ultimately. So that is incorrect. So make sure that you are matching, right? Matching the recognition of the income with the recognition of the expenses. That's a very basic accounting principle. So that means that you cannot recognize the expenses as they are incurred and then recognize that income months later or years later. No, the IRS wants you to match them in timing. So once a property is sold, you're going to recognize that income and then you're going to recognize the cost of goods sold, right? However, you're going to have other expenses as a house flipper that is not directly tied to the cost of goods sold. For example, let's say you have internet, you have your phone bill, you have your subscriptions to items online that enable you to work. Like, for example, let's say if you have a subscription to Bigger Pockets or you have a subscription to Google Suites, right? So all those don't go to cost of goods sold. because they're not directly tied to the flip. So those you can recognize as incurred. Okay. So I just wanted to explain that to you guys because I've been seeing a lot of flippers, do this incorrectly, and it results into them having to either filing a form 3115 later on to fix the issue, or sometimes they even have to amend their tax returns, and that results into them needing to pay even more money in professional fees. So I don't want that to happen to you. So watch this video if you are a house flipper and make sure that your bookkeeping process or your bookkeeper, if you hired one, is doing exactly what I mentioned in this video. So if you have any questions, if you have any concerns, if you are a house flipper and your books are a mess, or if you want to get into house flipping and you want to get off on the right foot when it comes to your bookkeeping and accounting, please schedule a call with our team. We would love to connect with you. And don't worry, your accountant handles that.